And then we are recording. Oh. Okay. Hopefully that echo's not going to hang around. No, we're all good. Right, okay. Where to start with everything that's going on right now? An economist's life is certainly difficult. I'm trying to get to the bottom of what's happening and what might be happening in the coming weeks and months. So where do we start? Well, let's talk about volatility. And this, so I really like this chart because it sort of tells you, what's happening right now is an experience shared. So again, this morning, the gilt markets in the news and the volatility we've seen for the past couple of weeks. Ask everyone silent.
Yeah, could I ask everybody to be on mute, please? Sorry, can I ask everybody to go on mute, please? Thank you.
There we go, excellent. Look, this chart on the top left tells us that in currency and in bond markets, volatility is high is what it was sort of around the time of COVID. And so that tells you that forecasting is really difficult, if nothing else. But it speaks to more than just what's happening in the UK and what's pulling at creating the tensions in financial markets, not just the UK, is what's happening with central banks tightening policy and specifically the Fed. So it's this classic story of the world's most important central bank tightening policy in response to the inflation problem. Our currency, your problem, and it's creating tensions right across the piece because the US is out in front in terms of the growth recovery from COVID, the extent of its inflation problem, and therefore the extent of tightening that's required. And so strengthening of the dollar is certainly not just about sterling. It's happening against the euro, it's happening against the yen, it's happening against emerging market currencies. And classically, this has been a source of problems in the past Fed tightening cycles. So we think about the 1990s and specifically in the Mexican crisis and various other crises that emerged over the decades when the Fed was on tightening mode, the 1980s and what happened in Latin America, etc., etc. So this is a problem shared, and everyone asks, well, when does it stop? Well, the pivot point, and that's the key word, the pivot, comes when there are verifiable proof that inflation in the US has peaked. Now, we're going to get some data this week, and it would be, the expectation is we're not going to get that conclusive proof. In fact, it's going to show that probably core prices have continued to edge up some of those core price pressures. So we await that point where the US has overcome or begun to tame inflation, and that's going to be key for what is a tension that's rippling across the global economy and financial markets. The chart on the top right shows, just how much tightening's had to be undertaken in response to this widespread inflation problem, at the heart of which sits energy. We'll come back to what's happening there right at the end. And so you see on the bottom left, that is contributed to in tandem with some policy announcements. It's the timing around those as much as anything that have been unfortunate, because this sort of week after week of building US rate expectations and the absence of conclusive proof on inflation being tamed, throw in some fiscal loosening and you've got a sharp spike higher in government bond yields. And as I say, you can see even this morning that the Bank of England is going to step in and provide market support measures, be a market maker of last resort, and just try to placate some of those tensions. So the point is that when you dig into underneath the reasons for this is, well, you can see these problems remaining for as long as we've got a US without evidence of inflation peaking. So that's really, really important. We might get that in the coming months. So I'm looking ahead to Q1, Q2 next year when we start to see some more evidence of that coming through. Now, markets think that when that does come through, the US will pivot quite quickly into rate cuts because the economy will need looser policy to try and soft land the economy, so there's not a hard landing that you sort of gently raise the growth profile, the performance of the US economy after having tackled and overcome this inflation problem. But we're not there yet. So what about this inflation issue in the UK? I've already talked about energy, and now into the mix we can throw the problem of a falling currency, just making our imports more expensive. And what that does is, so this expected profile of inflation falling next year, everyone expects that to happen. That's still the central case, sort of whoever you ask, whatever forecaster or whatever body institution produces an inflation forecast for the UK, they're going to tell you that inflation is going to fall gently over the course of the next year, with the pressures coming down in all the areas where the pressure has been building: energy, petrol, goods prices, services prices, and you can build a case around that relatively easily. What a lower currency does is it's going to slow that pace of decline. You're still going to get a decline in the rate of inflation, but it's going to slow that pace of decline, because what a fall in the currency does, and we saw this in the aftermath of the Brexit referendum and the fall in sterling then, there's quite a long lead time of the fall in sterling into inflation. It plays out not over weeks, but months and months, and as much as 18 months, perhaps even 2 years for it to fully wash through. So it's going to slow down that decline in inflation and delay the point at which you get back to 2% target. So that forecast there has you back to the 2% target by the end of next year. I think that's challenging, given this sort of recent fall in sterling, with further pressures, downward pressures building. Or to put it another way, you wouldn't be surprised if there was another fall in sterling. It might even retest that parity against the dollar. But I say that's an experience shared across currencies. The UK isn't alone in that. But there's good news coming through in all those elements. So goods prices we know had been driven by strong COVID-related demand, supply chain problems, high shipping costs, and all those things are changing. We've shifted into greater demand for services, the summer boom in travel. Inventories are building across the piece because of that demand shift. Supply chain problems have quite quickly righted themselves. And however you look at it, all the various supply chain indicators of stress that were set up in the past couple of years to try and get a handle on the degree of stress in supply chains, they've been coming down. Or whether it's the queues at the Los Angeles port, the queues of ships, all those have been coming down. So the number of ships waiting to board, or whether it's the number of ships sitting idle, that's been coming down as well. So those supply chain problems are fixing themselves. And there is the possibility that a period of inflation in goods turns into mild deflation in goods. That is a distinct possibility, and that would certainly be helpful to inflation. Of course, in the past couple of months, what's really helped with the prospect for inflation is that those pressures on commodity prices have come off because of the slowing demand point. So this has been squarely about the sort of reduction in near-term momentum in the global economy. And as ever, the sort of expected response within that is lower commodity prices in the near term. And so that's coming through, and that's really driven by China. And this has been important because it's contributed to Europe's ability, and you might say luck, in being able to get their gas storage levels up to a level that should see them through the winter, unless it's very, very cold. We'll be watching the weather unlike any other period in history, particularly through December and January. 28th of January is your day. You're going to be watching the weather closely in Europe until then. So that's really helped with reducing some of those near-term inflationary pressures as well. But look, this is a historically high inflation environment. This is a problem, certainly in the UK, that's yet to be overcome. On the rate side, I'll talk about that in a short while. There's definitely a case for some even steeper rises in rates than what we've seen, just to help bring this problem to heel. But what that does is, like the US, open up the possibility that you need to bring down rates in short order. Now, what I'm describing there for some of the older folks on the call who can remember central bank tightening cycles before the past sort of 10, 15, 20 years, that's what they looked like. There'd be periods of tightening and they'd quickly pivot into periods of loosening to try and manage the economic cycles, because economic cycles were more volatile. Inflation was more volatile. There was much more clear and distinct inventory cycles in the economy. And so in the decades where the UK was less services oriented, that was and more manufacturing oriented, that was the nature of tightening cycles. So it's probably a bit familiar to some of those folks on the call that can recall. So that's the prospect for inflation over the course of the next year. It's expected to reduce gradually, but key within that is a couple of things. What's happening to wages, right? So we know right now wages are falling well short of where they were of inflation. They're above where they were pre-COVID, so that's partly good news. But wage growth is running at a pace half, or just slightly above half the rate of inflation. So there's a real term squeeze on, and that's expected to remain the case through next year. Now, why this matters is, so we talk a lot about the lived experience of people amidst all this. As financial market participants and central bank watchers, you're looking at that data to when inflation peaks and thinking about that data as to when the central bank will pivot. But the lived experience of people and businesses is different, because the price level, you can have inflation at zero, but of course the price level hasn't changed from a year ago, so things are still expensive, right? So if you haven't had your business earnings or your household income that have caught up, you're still feeling the strain. You're feeling the pain of those high prices. And that's going to be really important as we work through this inflation problem, and the experience and the problems it creates and the tensions and challenges it creates around for households and businesses will outlive, very likely outlive the kind of the central bank and financial market watchers and when inflation peaks. So this is going to be with us for months to come, and I say, well, it has a long tail that will reach deep into and beyond the period when inflation peaks. So that's going to be another important part of the backdrop in the coming months. Right, what have we got on the next slide? I've jumped too far. Go on. So what's happening on the activity side? Look, everyone knows the score here. The data is telling us that the momentum's coming out of the recovery after what had been a decent, a very decent first half to the year. And whether this is some of the high frequency stuff around CHAP spend data, which is really useful. We're sort of at the aggregate level, we're kind of plateauing, which is probably not too bad, all things considered. Inflation has been building for a few months. But the chart on the bottom left, the PMIs tell you, that momentum's coming out on both the services and manufacturing side. And firms are saying similar things. Order books are thinning. Some are pivoting to hiring freezes to be a bit more cautious on growing labour pools. The labour market is tight. We'll talk about that in a minute. But the prospects are for a cooler period of growth moving into. So don't place too much emphasis on this morning's data, which saw the unemployment rate fall to the lowest since 1974, 3.5%. Underneath that is a cooling labour market trend. And you've got firms' expectations on sales growth next year gradually trending down, although again, there's probably a little bit of resilience in there. Sharp reductions in forecasts, and so this is the UN Trade and Development, but whether it's the IMF, and we'll get an update this week from them, or the broader consensus. So if we rewind the clock about 6 months, everyone thought that the UK economy would grow about 1% next year. So that's now down to just below zero, so minus 0.2, and many are below that. So thinking about looking at minus 0.5, minus 0.8, and that is the cumulative impact of inflation and higher rates, damaged confidence, and slowing global growth. So all things coming together really to make for a much more challenging environment. Technical recession, that's very easy for the UK to experience over the course of the next year. It's probably going to feel a bit more than just stagnation. That might have been how we described it a couple of months ago. It's now going to feel more like, this is really quite challenging. It is a drop, a modest drop in GDP. It's not a recession on the scale of what we experienced in the 1990s, say, when the economy fell 2%. But it is a challenging period, and there will be a marked difference in the strength of the labour market, which has and remains right up until now, the UK's trump card. I say that what's coming through in the surveys, hiring freezes. So I think it's reasonable to assume that unemployment will drift up a bit in the coming months. Now that's mostly about returning labour supply. This has been a new and quite worrying development in the UK labour market over the past couple of years. We've been so successful at putting people into work, raising the employment rate, and that was put into reverse during COVID. I'm really struggling to reverse that. And so there's a couple of things happening. So early retirement certainly one. Those sort of felt they had enough and had enough to keep them going, and so decided to depart the labour market early. Long-term sickness is certainly a problem, and obviously the relationship between long NHS waiting lists and the number of people in long-term sick is certainly an issue. But there's other things happening there as well. So let's take about the universal credit, the taper rate. That likely needs to come down to incentivise more people into work. It's probably one of the things that could be holding back work a little bit, because it's not paying enough. It's just the incentives are not quite there, and that's possibly one of the reasons why we've seen a sharp uptick in the number of people on working age benefits and universal credit. So it spiked sharply around the time of COVID, and it's yet to anywhere near fully reverse. And that's probably one of the issues there. But there's a host of things that have gone on that are going on around the labour market. I think the labour supply will continue to improve gradually. Immigration's coming back as the world gets over COVID, and the relative attractiveness of the UK labour market should pull in some labour. There's been some policy indications of a change in policy from the new government. Some of those long-term sickness issues should alleviate themselves. As I say, dealing with the universal credit taper would also help. And what that increased supply is probably going to lead to an inch up in unemployment. So this is call it a relatively benign rise in unemployment rather than firms pivoting to labour shedding. But clearly that's a risk. The UK is vulnerable to a recession. And that is the way to think about the world right now is, so if you're planning on the basis for next year and this kind of difficult, challenging environment, you'd probably want to attach a reasonably high probability to a downside outcome where there is a recession, and probably begin to plan on the basis for both, because the chances you get there are unusually high, such as the vulnerability presented by high inflation, high rates, and businesses that are facing higher borrowing costs, higher debt servicing costs, and possibly needing to reduce headcount to deal with some of that. And that's really the kicker for recession, is when labour shedding starts. Then you get material downturns in consumer spending. So it's that vulnerability to a full-blown recession is the way I'd characterise the coming year. So you want to plan on the basis for being resilient to that. Right, let's talk about rates. In a way, markets have moved ahead of where the Bank of England is, because, as is grabbing all the headlines, mortgage rates have inched up in line with where market pricing is. Now, one way of looking at that is the Bank of England's lost a bit of control around monetary policy, right? Because the indications are that it sees from its various forecasts this year that it sees rates at that level as too high for the economy, more than what's needed to bring inflation to target. And almost reflecting that view for the Bank of England is where consensus thinks rates will head. And we've got two numbers here in coloured circles. On the right is what market pricing indicates bank rate will go to. That actually might be 5.75, and it was 5.75 yesterday. And whereas analysts, forecasters, economists think it'll be 3.75. And that speaks to that point about the impact that higher rates has, particularly around debt servicing costs. The Bank of England's acutely aware of this and does a lot of good analysis around it as part of its financial stability remit. And this chart on the bottom left does exactly that. And it looks at the share of households with a high cost of living adjusted debt servicing ratio, greater than 70% of net income. And look, a 3% bank rate and a 9% inflation rate, and this is the Bank of England's own analysis just from a couple of months ago, gets you to almost 2% of households at that level. So what does a 4% bank rate do as per forecasters, and an 11% inflation peak, which is what the current forecast is? Well, obviously it's going to push it higher. And market pricing, 5.5%, that's very likely to take you beyond that pre-financial crisis peak. So we really are back into a world where debt servicing costs really matter, and the share of households for whom it becomes overly burdensome is getting on for being significant, right? So these were the sort of the considerations around sort of thinking about the world pre-crisis, and then we're kind of were lost, were forgotten about because rates were so low, and we dealt with the problem. Low rates were this incredible benefit to keeping debt servicing costs so low, so manageable, and creating room for growth. And that was the characterization of the world post-crisis, pre-COVID. Now, so we're moving back into that world pre-financial crisis where debt servicing ratios and costs really matter. Now, you might say, well, wait a minute, what if these market rates don't stick? I think that's really important, and it's really the key swing economic factor in thinking about whether you're in a base or a downside. Interest rates at these levels, if they really stick, are going to pull down and grow sharply. It's going to be really difficult to get economic growth with interest rates hanging at these levels. Maybe just to illustrate, so if you're coming off a mortgage right now, you're seeing your on average, you might be seeing your monthly payments go up £400, £450. You've got about 2 million fixed rate mortgages that will come up before the end of 2023. So you work that through, and you're comfortably looking at over 0.5% of GDP, maybe about 1%, probably a bit more, of the total wages and salaries of everyone in the economy, which is a figure that comes in at about the trillion mark. So you're taking 1% out of that just by the end of next year. So when growth's already weak, when you're struggling for momentum, that's really going to matter, right? And it's this possibility that that is sufficient to pull down on consumer spending and broader aggregate demand, and really lead to that really worrying development where recession dynamics kick in and labour shedding starts. That's the downside. The base case is that interest rates, that these don't stick, what we're seeing in market right now, and they come down over the course of next year. And that's going to be super important for achieving this base case view, when all we experience is just a sluggish environment rather than a recessionary one. But look, this, talked about the lived experience of households, and what matters here is just the difference across the income spectrum. It's probably never been so different as it is now. There are still huge pots of COVID-related savings sitting in accounts, and that's a sum that amounts to 190 billion, right? That is enormous. It's 8-9% of GDP. It's a really, really huge sum, and it will offer many protection. Throw in what's happening on the policy side, and the chart on the bottom left takes that as where it's the energy bill discount, cost of living payments, council tax rebates, NI thresholds, etc. The other reversing of. Then it really matters for households' income dynamics. It's still going to be a major squeeze for everyone. It's still going to be a big squeeze next year, but this does make the policy support makes it far less than it otherwise would be. Again, supporting this view that we get a sluggish growth environment rather than a recessionary one. But on that savings point, we'll look at the share of households that they'd be unable to afford an unexpected but necessarily expensive at £850. That's just been trending up. So that's inflation biting for those who had managed to accumulate a little bit of COVID savings, those on lower incomes where there was evidence that managed to accrue a little bit, then that looks like it's being exhausted. So savings are being dipped into for those on lower incomes to support spending, support living standards. At the higher end income distribution, the story is very, very different. And that's again, is important for thinking about the path of the economy next year. There is a bit of resilience there. So it would be really easy to forecast a recession in this environment, to call that downside, to say, well, that's it, here's a recession, unemployment's going to rise, house prices are going to fall substantially because there are so many headwinds facing the economy. And a lot of the support and some of the resilience comes back to these savings pot that sit high up the income distribution. It is not the salvation. It is not going to prevent a slowdown in the economy, as the data is telling us right now, but it is something that provides a little bit of a cushion. And that matters not just for households, but for businesses as well, in a lot of sectors that are really tied into that sort of strength of the consumer. I like this chart on the bottom right because it tells you about the the difference it makes on the energy price freeze. That it's the socialised cost of the energy price guarantee, and it's hugely significant. It is a sizable package that is helping protect households from the harsher impacts of what we're seeing in energy markets right now. So I've talked a lot about the issues and challenges facing the economy and the differential experience across income deciles. We've talked about problems in financial markets, and again, we're seeing play out this morning the tensions there from a rising dollar, slowing growth, downgrades to growth, not just in the UK but across the globe. The challenges around public spending associated with providing protection from high energy prices, and that sits at the heart of all of this. The thread running through all those problems are energy prices and what's going on here. So the question is, well, why is there a problem with energy prices? What is putting this upward pressure, or has put this upward pressure on energy prices like nothing else we've seen? There's a great statistic. So you'll recall when oil went negative during COVID, and they were reckoned to be pretty much the lowest energy costs in human history. And we've gone from that to, over the summer, when that blue line was at its apex there, the highest costs in energy in human history. That's a big swing. And if you ask people what's happening here, they'll say, well, it's the conflict. It's the Russia-Ukraine conflict, and Vladimir Putin weaponizing gas. And they'll say, oh, well, there was idiosyncratic factors. We had a cold winter 2021, problems with supply, sort of numerous idiosyncratic factors, whether it's electricity production across France's nuclear fleet, unusually long maintenance levels in Norwegian gas infrastructure through 2021. And they'll list out all these things that have caused, many of which predate the Russia invasion of Ukraine, and then that compounded things. And they'll say COVID and the resurgence in demand and how strong the recovery was. And none of them get to the heart of the matter. They all do matter. They are all important. They all have compounded an existing problem. But this, sorry, Forbes, you jump in. No, all good. I'll finish and then we'll get into some. Oh, hello. So this is actually an old problem. This is a really old cycle in commodities that we've seen play out over the past, not just decades but century. Won't go through the full history of it, but why did energy prices rise so sharply in the 1970s? It's because in the 1960s, capital had been drawn away from commodities and increasing supply. Prices were low, they weren't attractive. There was far more attractive returns and investments to be made in the nifty 50, the sort of tech titans of their day. And that set what happened in the 1960s set the stage for the 1970s. Problems compounded by war in the Middle East and huge and sustained upward pressure on commodity prices. Price signals worked, the supply response came, but it didn't come until the 1980s, and that aligned with new technologies and the ability of offshore drilling, whether it's in the North Sea, Gulf of Mexico, Alaska, various finds, including in the Soviet Union, and there was a strong supply response, and that set the stage for lower prices. And in the 1990s, we enjoyed low energy prices for the most part, and again, returns were poor, capital was drawn away from commodities and into the internet bubble. That was the attractive part where capital wanted to go. That itself, the cycle was repeating. We were seeing the cycle repeat with capital drawn away. It was setting the stage for the run-up of prices in the 2000s. Coupled with China's rise, strong rise in demand, strong global growth, and you had a problem in commodity markets. You had reduced supply, and so the pressures came in, and famously oil hitting $140, $145 a barrel. Price signals worked, supply response came, and in the 2010s, the huge importance of the shale revolution in the US. But behind the scenes, the problems were being created again for high energy prices through capital being drawn away from hydrocarbons, and the cycle is beginning to repeat. This is the period where capital should have been flooding in. Now, we've attempted to divert capital from hydrocarbons and into renewables. The problem right now is we're caught in that difficult period where we still remain reliant on hydrocarbons. Global oil demand continues to rise. The amount of oil the global economy needs every year continues to rise. And we're still reliant on hydrocarbons across the piece. So we're in this really, really difficult period of wanting to achieve a net zero transition while remaining reliant on hydrocarbons. It's making this difficult period right now. So the question is, how long does it last? The answer is potentially years. And so that fall in the blue line and the recent decline in oil price that I've talked about is potentially just a short period of decline amidst weaker global growth, and that we will resume this upward trend in commodity prices owing to this lack of investment while we try, hopefully as fast as possible, to move to a net zero world. But that's going to make the 2020s, or most of it, really, really difficult. Price signals work. The supply response will, in all likelihood, come. It's just that they take years. So whatever you're talking about, drilling for gas or oil, whatever, all these supply responses take time, and it's starting to show up in things like, maybe the best example is, so the news that grabbed the headlines last week was OPEC's production cut. However, none of the OPEC members were producing anywhere near their quota. Why not? Exhaustion, right? So fuel depletion, right? Yeah. Again, this is the lack of investment point. There's real tightness in those markets, owing to this underinvestment piece, fields reaching maturity, and the lack of clarity on just how much, how productive, the big fields in Saudi Arabia are, sort of a well-guarded state secret, the degree of the reserves, etc., etc. But all the indications are that we've just got really, really tight markets across the piece. So this is going to be a challenge for years to come. And going back to that inflation point, the kind of mean reversion that all economists assume will get over this, you could start to unpick that and start to debate it and wonder whether actually, if this element of the 1970s is on repeat, then we are going to see further bouts of upward pressure on inflation driven by what's happening in commodities, while we try to transition and do things like uncouple the prices of electricity from gas, so that you'll provide stronger incentives for moving to a more electrified economy. But I think that's going to be the important backdrop, and that really does get to the heart of the matter here, rather than just some of these other short-term and idiosyncratic factors that do matter, but they compound an existing underlying issue. Right, I've talked long enough. I think my clock's hidden. I'm going to stop and take some questions.
Thank you very, very much, Marcus. Do you want to just take that slide down for a second? Brilliant. We've got a few questions which are coming through on the chat. I just want to quickly get on to something which I kind of heard a little bit yesterday, the sense of, you were talking about the recession, saying that we can expect a little bit more stagnation, but somebody was talking the other day about the danger of kind of contagion in terms of how what happens here kind of ripples out to Europe and then kind of ripples back to us again. We've clearly seen during COVID how we are so interconnected. What are the ramifications of that?
That's a really, really good question, and it's playing out in both a financial market and real economy sense. So dollar strength was creating tensions in bond markets globally, and is. What the UK did sort of compounded that, not just for the UK, but had started raising flags for both the US Treasury market and the Italian government bond market and bond markets globally, because the gilt market is big. It's certainly not the world's biggest, no way. There are more important bond markets, but it speaks to that point about feedback loops, because you've got pre-existing tensions. The real economy, it's the same thing on the real economy. So energy costs are share of GDP. The differential between the US, Europe, UK now is absolutely enormous. It's really never been so big, right? And so Europe is very likely to have a harsher downturn than what we are, and that ripples through us because of the demand for our exports. We still export a lot to Europe, and it matters for the global economy because Europe is so sizable. And you pick your engine, and you've got of the global economy, and you've got problems in them all. You've got slowing momentum in them all, and that starts to create this feedback loop on the real economy side as well. Deterioration on the economic sense creates pressures on the fiscal side, bond markets, and so they are the two link, right? Because in any downturn, it puts pressure on public spending because of automatic stabilizers, etc., efforts to protect customers and businesses from high energy prices. We're all putting in place enormous energy packages that are 3, 4, 5, 6, 7% of GDP across Europe to protect business and consumers. Further pressure on bond markets and fiscal and bond issuance. So you're right, that is clearly the risk, and it morphs into not just a mild downturn, stagnation next year, but actually it's just the kicker for a broader global recession. Hence the point on you want to be closely thinking about those downside outcomes rather than I'm convinced we'll be all right here, or I'm convinced that we're going to have a really, really bad recession. That's the vulnerability uncertainty piece and why it matters for planning.
Thank you very much, Marcus. Thank you. So the two quick questions, each have actually asked two parts. So if you pardon me, I'm just going to take one essence. There is something which I think everybody who is in the position with the mortgages and remortgaging, obviously the last 10 days, 2 weeks have not really helped them. And I appreciate you're not a mortgage advisor, but there's the question is that sort of what is the suggestion about remortgaging? If people are able to wait to the end of the year to secure a better rate, where do you see that sort of trend? Is it a case of let's just hold on as long as possible? Should we wait? It depends on so many individual circumstances, but just generally, where would you see that?
Right. Okay. So we've got very, very careful here. I say I'm not a mortgage advisor, so I'm going to give this a pure economist take on what's happening with interest rates. So I've talked about here today is rates at these levels really start to exert downward pressure on the economy. Now, from the Bank of England's perspective, if you take their forecasts, whether it's their August forecast or their May vintage, they've said that rates at the level implied by markets take too much heat out of the economy, bring the rate of inflation below target on a medium-term view, right? They've said that time and again. They said it with respect to rates being at 3%. What we've learned over the past month is that 3 has probably risen, or maybe put it differently, the level at which the Bank of England thinks the economy needs to bring inflation to target is probably risen as fiscal support has built up in the economy, because fiscal's doing, is pushing up on inflation and it's providing that protection to households. And so the Bank of England are probably saying that we'll probably need to go a little bit higher. But rates at the level where we're currently at takes too much heat out of the economy. So now what happens? Well, either the Bank of England successfully walk back that market pricing when they next speak in November. They say, guys, this has gotten completely out of hand. There is no way the economy needs rates at that level. We're not taking rates anywhere near there. And the markets will respond by saying, don't believe you. We'll stay where we are. They'll say, okay, you're right. Actually, we've gotten a little bit off there. We have seen in the past, we saw this over the past decade and a half, the Bank of England funnel cheap credit into the economy to try and get things moving. Is this another one of those experiences? Potentially, who knows, right? But that is one of the ways in which this issue could resolve itself, is the Bank of England attempting to funnel cheaper money into the economy. Now, nobody knows if that's going to happen. I don't, but it's, as I say, it's been used before. So that's maybe the most careful and diplomatic answer I can give to that question.
Thank you. And just one little note, you mentioned sort of the Bank of England may say something and the markets say, no, we don't believe you. Which is the dog and which is the tail at the moment?
Yeah, well, so yeah, it's a really good point. So yeah, what's happening right now is, so markets, so given where swaps are, where it's just where mortgages are priced, and that's pulling, and swaps reflect, that's market expectations on rates, that's pulling up mortgage rates, right? So that this is this point about monetary policy, in a way, tightening at a level and to a degree more than what the Bank of England would want, be comfortable with, and what its indications have been would like to see. So that is something around which there needs to be a resolution. And the Bank of England next meet, to set rates where a large rise is expected in bank rate. That's why, probably more importantly, is what it thinks about where market rates currently are, and if it decides to do anything about it that is sufficient and successful in bringing those rates down.
Good. Thank you. There's another question here. I'll just read it out as it reads. Given your comments regarding the lag on energy supply coming on stream, would you suggest small businesses be looking to peg their electricity, gas supply for 1 or 2 or 3 years, i.e. longer or shorter?
Yeah, good. Again, I'll stay away from the advice. But you have got policy. There is policy uncertainty. We still await details of. Well, so we've got support for 6 months. Then it's vulnerable industries. Who's going to be on the list? There's a lot of industries and businesses that would rightfully claim to be on that list, and so we really do need clarity around that. I was actually speaking to some of your peers around Edinburgh Way last week as part of a dinner, and that's what they're saying. This uncertainty really matters, and it does hold them back from investment and hiring decisions. So I take the point. It's short term. So that you unpick it, it's short term downward pressure on commodity prices, given what's happening in the global economy and momentum, and that looks like it's going to last through next year. But the structural story is upward pressure here on some of those hydrocarbons, just given market dynamics, and within the net, it's going to take some years for that supply response to right itself. So it's
Thank you. Again, this question slightly maybe a bit of a reach, but there's a question regarding sort of the SME markets on the high street, in terms of the turbulence which they must be facing in retailers and everything connected to the high street. You can't help but feeling it's like batten down the hatches, and every week, every month you hope to get through. But I mean, the high streets, I mean, how much, what are the winds really going to do going through it? It's going to be a tough Christmas, isn't it?
Yeah. So I noticed just last week some of the labour market data, coming through, that hiring for Christmas has been strong, and there'll probably be what are now feel like customary stories around labour shortages to meet that demand. You've got, so maybe bring it back to the point around this: the economy is slowing, and consumer spending is going to lead on that because it's rate of inflation, and ultimately money's being transferred out of the economy elsewhere, running a current account deficit to pay for energy, right? So that we're all getting poorer, and that inevitably hits retail sales. The news could quite easily be a lot worse absent those, the dynamics for those up the income distribution, where a lot of the spending happens. I'm not talking about the rich of the rich, private banking. We're not talking about that. We are talking about the top 30-40% of the income distribution, where you've seen where you've got fiscal support. You've been able to accumulate a bit of COVID savings. You can hedge some of the cost of living rises because you can avail yourself working from of working from home. It's those on higher incomes that are generally seeing the bigger pay rises right now, in contrast to the world pre-COVID, when it was those on lower incomes as the living wage rose. So that's a turnaround. You know, you are seeing, there are plenty of people seeing 5%, 6%, 7% pay rises and strong bonus payments. So those are important dynamics that are offering some protection for retailers and for consumer spending. You know, there is a reason why the boom in travel this year, you know, and output in parts of the leisure and hospitality sector has never been so high, right? Because there's health across that consumer piece in certain parts, but we cannot escape the slowing trajectory because inflation is just so high, and now mortgage rates are ratcheting higher too. So it's going to be a difficult year ahead. It really is. It's sort of like a well-flagged difficult period that has the risk to morph into something that all the more difficult. At the moment, no one's forecasting a big spike in joblessness, and that's key, because that keeps spending and will prevent a bigger fallout in the housing market. So prices will likely fall, but it's low single digits, which is perfectly, we can all handle that given the 20-25% run up in house prices that we're seeing during COVID.
And just a final question, because we're coming up to the hour, and I know Rochelle's got a few notes to share with everybody. It's an observation in terms of, we obviously there's been the recent train strikes and sort of the demands on trying to get salaries up to meeting inflation, and obviously there's been conversations for sort of for the benefits to be pegged more to inflation rather than to earnings and things like that. If that movement to actually getting the salaries for benefits up to inflation and more of these strikes coming through, what's the ripple from all of that? Because there's good arguments. You can understand why these questions have been asked, but the notion of the power of the strikes, certainly for nurses coming through, and there's more demand of raising for those folk to get the salaries up. What's the repercussion for this?
Yeah, so look, it's a really good question. I'm of the view that, you know, that's perfectly fair. That's a well-functioning market. If people are able to ask for, wrestle, achieve higher wages than what they otherwise would be the case. It's the natural reaction of many. What it does is feed into it. It brings back to this point about, well, when do we see the end of the tightening cycle from the Bank of England? Because if that's sufficiently widespread and remains widespread, and the pressures on core wage growth will remain elevated and give the Bank of England cover to continue tightening, and therefore raises. But you're as a flag, you're starting to get to the level where, those debt servicing costs, some of those financial stability concerns really start to come to the fore. So you start to increase some of those financial stability risks by the extent of the tightening needed in the economy to bring inflation down. Now, the hope is that through a combination of, well, rates will do their job, higher inflation, and I've talked a lot about slowing consumer demand, that will feed lower inflation, lower commodity prices, lower goods prices because you've got elevated inventories, and you suddenly pull together a story for inflation coming down and leaving a lot of pressure and heading in the direction of target. And that will give the Bank of England cover to stop tightening. Now, the lesson from the 1970s is, well, you can get inflation on a downward trajectory, but you haven't solved the problem, right? And so you by loosening too early or refraining from further tightening, you set the conditions for inflation to continue to rise again. Now, the world is more financialized, more reliant on debt now than it was in the 1970s, so that bit's more likely, right? So that's clearly the risk, that trying to soft land the economy into this is going to be really, really difficult, and that it's unlikely to be a one and done. If it is, it would be quite remarkable. So great start. 15 tightening cycles in the US since the 1950s. 10 have resulted in recession, and you were more likely to have a recession the greater the deviation of inflation, and in the case of the Fed, in the case of the US, unemployment from target. So the greater deviation of inflation and unemployment from target, the more likely you are to have a recession. Soft landing the economy rates is really, really hard, right? And it's a really, really difficult job. And that goes whether it's the US or the UK. So increase the risks, increase the likelihood that you're going to hard landing the economy. So that's the issue there. But yeah, people have an incentive to go and get the biggest wage rise they can get, and that seems to make sense to me.
Thank you very, very much. There's a tremendous amount of great content with what you've said there, Marcus. And as I said to everybody at the beginning, this has been recorded, so I'm sure Rochelle will be able to circulate the link for this once we've got this downloaded. It's immensely challenging period, and we're not alone with this. I'm sure that people in different countries are experiencing the same thing. I just hope we can try and find a way of minimizing these spikes sort of by certain decision making, because we all need a period to really restore some faith and to restore that confidence. We have desperately got to get confidence back. And I think there's a lot locally in Kingston that a lot of businesses are trying to do. But as usual, the business environment is very entrepreneurial. They find different ways. But going back to what you said at the beginning, I always believe if businesses know what they're supposed to aim at, they've got something and they will go and achieve it. But if that keeps moving, it's really, really difficult. Thank you very much, Marcus. Rochelle, do you want to say a few words to wrap up?
Yes, thank you. Thank you, Forbes, and thank you, Marcus. Yeah, just wanted to share the feedback form. So thank you for attending, everyone. Before we wrap up, I would like to ask you to take a few minutes, just a couple of minutes, to complete our feedback survey. As always, this is really important to help us improve in the future and deliver great events that are relevant to you. There are two questions around your host today, which is myself, Rochelle Tomlin, and the event, we're going to class this as an audience with, which I think is the second one on the drop down. So number one, would you recommend the event? And number two is, would you recommend the NatWest brand? So it's really important, for us, because we work with NPS format, NPS, which is Net Promoter Score, which is used in organizations to measure customer experience on a score of 0 to 10. So it's really important for us to, and 9 and 10s are promoters, to receive promoters. Obviously 7, 8s and below are passives. So if it is below an 8, then I would appreciate the feedback. But yeah, if you could just take some time to yes, the QR code, use the QR code. I will email this out as well through Eventbrite, the link, if you cannot access the QR code. I think that's it from me. I don't think there was any further questions. So thanks again to everyone. I will be tweeting this and on LinkedIn as well. So do like and share this. And thank you so much, Marcus and Forbes, Kingston Chamber, as always, for supporting NatWest with our events and generally with everything else as well. So thank you all, and have a great day. Anything else from you, Forbes?
No, I just say I appreciate you bringing Marcus together for this, and for the support from NatWest. As you say, there are in the link in the chat, your business builder, your NatWest Accelerator program. Yep, and yep, let's just keep plugging away. But thank you so much for your time. And as I say, we will forward the link for the slides and the video at the appropriate time. But thank you for your morning and for your contributions. Take care of yourselves. Thank you.
Thank you, everyone. Have a great day.
Bye-bye.
Bye.